Maybe pick up where Evan left off, Tim.
To agree with Evan, I don't really like this suggestion of Wesfarmers increasing its coal assets. As I mentioned, coal looking like it's in decline now. Prices have been very soft, production-wise and supply-wise, hasn't been looking attractive at all. If you look at Wesfarmers as a business, it is a diversified business, and it's been very successful within sort of that diversified business kind of space, because often there's a lot of people saying that diversification doesn't really work. You know, hear the word diversification being thrown around, but Wesfarmers has been very successful in this, but I think largely it's been due to its very smart acquisition process and also its ability to turn around businesses, particularly within sort of the retailing space. It's been the likes of Coles and Bunnings and the turnaround in Kmart that's really been a big driver for Wesfarmers, because you'd have to say that the coal conditions for coal producers over the past year or two have been very tough. Prices have been sliding and it's not looking like it's going to get a whole lot better. I think one of the issues here, I think Wesfarmers, if you look at their coal operations here in Australia, they've got operations both in Queensland and New South Wales, but they've also, I believe, locked into some pretty long-term port contracts, sort of 10-year contracts. And at the moment, you look at some of the ports around Australia, for example, in Newcastle, we heard Whitehaven Coal actually suggest that around half the capacity that's being sold out of Newcastle coal by 2014 will be being sold at a loss due to these long-term contracts at ports. So I think Wesfarmers at the moment, really, it's also mentioned that it's going to be looking at acquisitions offshore. Richard Goyer said this was inevitable, but their acquisition strategy has been pretty smart in the past, so I'd be interested to see what acquisitions they do take up offshore. But in terms of this expansion of its coal capacity, I don't really like that suggestion. I think the capex number is important, but there was an interesting note put out, I think it was by UBS, saying that a substantial fall in the Aussie dollar could actually push inflation higher. So while capex numbers certainly bring the RBA into play, a continued fall in the Aussie dollar could see inflation push towards the top of that sort of 2 to 3% inflation target band for the RBA. So may well also affect it in the opposite direction than some disappointing capex numbers at the same time. But I think there's been calls, you know, people saying that the big miners are going to benefit from a lower Aussie dollar, which is true. I mean, you look at the big miners, a lot of them are receiving, you know, a lot of their costs are already in US dollars, but a lot of the smaller and mid-cap players, where a lot of their costs are in Aussie dollars, are probably going to benefit more from a lower Aussie dollar. But at the same time, could this lower Aussie dollar sort of be a precursor to some sustained lower commodity prices for the miners as well? So I think there's a little bit of an argument for and against it in terms of the miners at the moment.